Hi guys, good afternoon and welcome to MF Corner. I'm Pavitra, with me is Sonal, and today we're joined by Joydeep Sen in the studio. Thank you very much for joining us and for coming down to the studio. We were just talking about this before as well, that it's much better when we're in person and the conversation is much nicer. And of course we have you with us on Policy Day, which means that there are a lot of questions on debt funds. There's also been that big tax change that we were discussing. So Sonal, perfect day for us to be discussing the debt fund picture.
Oh yes, it is. And after it is the second time we've seen a pause, and the indication is that it'll continue to be a pause before there's a cut, because that 4% inflation target was the big pressing point. But let's come to the mutual fund industry, because debt funds have been in focus for many reasons. But for now, we'll speak about the RBI policy impact. The basic question: what do you think the impact is on debt mutual funds?
So thank you for inviting me. So on the RBI policy, it's a mild positive. So everything is same. The car is on track as per Google Map, going tuck, tuck, tuck. The inflation call is lower now. It's now 5.1 for the financial year from 5.2 earlier. But everything is same, like the GDP forecast. Now on this stance, officially it's a hawkish pause, but the fact is they will not hike now. It's a long pause now. And there are calls for a cut which may happen in Q4, like Jan-March 24, but that depends on so many variables. But as of now, it's a long pause from the RBI. So that was a positive for the debt mutual fund industry, because the yield levels will be kind of in a range, and so it will be a accrual-based returns for debt mutual fund investors.
Okay, got that. That is the immediate take on what the policy impact could be. But take us through a slightly broader question. For someone who's looking to get into debt, do you need to pay too much attention to what the RBI does this time or what they're going to do in the next meeting? How would you advise someone who's not too educated in this space but wants some amount of debt exposure?
Just to give you a broad perspective, one wise man was asked, when should you eat? The answer is when you are hungry. So similarly, when should you invest? When you have money. So don't time the market, just invest. All you can do is an SIP kind of approach, be it equity, be it debt, be it any other asset class.
Average out.
Average out, yes. So that is the approach. Now coming to debt in particular, to give you since you said broad perspective, if you look at it 2 years earlier and if you look at it today, things are much better now. What we call the accrual, as in the yield level of the debt funds, it was much lower 2 years ago. Rates were low. Today rates are high and you have a much decent accrual level, so you can invest even lump sum now without timing the market, as long as you have the horizon. That is important. So there are 16 fund categories plus target maturity funds. So you decide your horizon and you pick the appropriate fund category as per your horizon for your investments.
Okay. Just to follow up on that, since we are talking about yields and rates here as well, but usually it's not the best time in rising interest rate scenario, because it's inversely proportional, right?
Yes.
So in a case where we are here, when there would be a pause, how do you think the debt pricing or yields would work in that case?
So as we just discussed, it's a long pause from the RBI. So I see stability here. So if we bifurcate, or if you look at the yield curve today, the curve is very flat. So what it means is the yield on a 1-year instrument, 3-year instrument, 5 or 10-year instruments kind of flattish. You don't get the uptick. So what it means is even if you take duration risk, which means investing long maturity bonds or bond funds, you won't get the compensation. So you have to match your horizon with that of the fund or the particular bond you are investing. Otherwise you get accrual based returns without much of a mark-to-market gain or mark-to-market loss.
Understood.
Okay. So that is on the RBI policy. The other big talking point, and we've spoken so much about this, is the debt fund tax changes, right? There's been too much talk about it, and of course with good reason as well. But investor interest has waned a little bit, whichever way you cut it since then. How would you read into this, and how much of a difference do you think this actually makes?
Yeah, so that has happened. So I'll make 2 points here. One is allocation. Allocation in the portfolio is always relevant. Equity, bond, gold, anything else like real estate, commodities, that is always relevant. That is with or without tax efficiency. That you have to always do. My second point is, if you look at it objectively, tax rate is same now. Debt mutual fund, bank deposit interest rate, bond coupon, tax rate is same. Maybe a higher tax of maybe a few months, then people will realize. And what market history shows is that if you look at a long time period, anything happening in the market, people react emotionally, but then things settle down. So now after a few months, it will be a comparison on merits of the products. Like this is debt mutual fund, this is bank deposit, this is bond coupon, this is bond. You compare and you invest as per merits.
So it's tax neutral now and not tax positive. So that's how it has brought everything at par now.
But this is so true, right? That whenever you get a decision like this, the immediate reaction is just, especially on the tax front, people get so scared that it's perhaps even just a little bit moving away and staying away from the category to see how it plays out. and then you might look at it as well.
Okay, so when we are talking about the taxation bit and long-term capital gains, the indexation benefit that they got, so is it across all the categories in the debt field, or there are some which are still enjoying that?
Yeah, that's an interesting bit. So actually it is still there. To explain this bit, if you look at the language of the Finance Act, which was recently passed, so what the Act says is not debt funds per se. What the Act says is funds with equity allocation rather a limit, 35%. So that includes debt funds, includes gold, and includes global equity funds. So that is what we call debt taxation, STCG.
Yeah.
And then we have the conventional equity funds beyond the threshold of 65% equity taxation. Now the category in between is this indexation thing, and holding period of 3 years is still there. And people can still enjoy the benefit for fresh investments also in this category of funds.
Okay, so take it a step further. Then what is within the 35 to 65 kind of bracket where, you would still get that benefit?
So as of now, there are certain multi-asset funds, MAFs being positioned there. Now there are 6 hybrid fund categories. In certain funds, there is a limitation of SEBI regulation, like conservative hybrid. Maximum so much in equity, can't go beyond that. Arbitrage minimum so much in equity, can't go below that. Equity savings minimum so much in equity, can't go below that. So multi-asset is open as of now, which is being positioned by certain AMCs. Plus, just in case there's a revision by SEBI on the regulations, then we may see more funds being positioned here. But as of now, it is multi-asset only.
Yeah, right. Exactly. That was the first thing that came to everyone's mind after the debt taxation also came up, that maybe multi-asset funds would see higher inflows because of this. So that is something, of course, would be an option as well. So now in this case, of course, this is something that is a question you would get very often after this tax change that has come by. What is better for an investor? Equity taxation over 1 year or debt over 3 years with indexation?
So I did the numbers earlier. As per history, as per debt indexation, that was actually better. Now, what is the meaning of better? 10% threshold.
Yeah.
Equity 10% LTCG over 1 year, and debt 3 year, it is lower than 10% as per history. But the point that is for debt funds, if you look at equity funds, can give higher for 1 or 2 or 3 years, maybe a different thing there. But generally for debt funds, LTCG is better.
Okay.
But again, to clarify here, we are discussing a band of equity, which is not pure debt funds. So kind of little bit here and there, kind of equal, depending on inflation.
Okay, got it. That is very useful, to hear from you. We have a lot more questions, but we do have to take a short break. So we're going to do that and be back in just 2 minutes. Stay tuned. We'll continue our conversation with Joydeep Sen on debt mutual funds.
Welcome back. You're still tuned into Mutual Fund Corner, and we still have with us Mr. Joydeep Sen to talk all about debt mutual funds, especially in the light of what we have seen with RBI pausing the rate hike for now, and what is the impact on debt categories. We have spoken a lot about it, but let's go one step ahead, Mr. Sen, because we've been speaking about how there have been a lot of changes in debt taxation as well. So right now, for the usual debt categories, what should the investors do for fresh deployments? Is there anything specific that they should keep in mind?
Yes, interesting point. One thing is open fresh folios. Why so? Just to look at the background, the taxation earlier was till 31st March 23. Benefit of indexation was still there. And from 1st April, it is the new tax regime, LTC for any holding period, short-term capital gains taxation. Now, how does taxation work? Taxation works on FIFO, what is first in, first out.
Okay.
So what may happen is, if you confuse the same folio, as an investor in the same folio, FIFO basis, so it may be a new investment less than 3 years, or you may want to continue with the benefit for more than 3 years also. To avoid the confusion, keep the earlier stock in the earlier older folio and open fresh folios for the fresh investments to avoid the confusion.
Correct.
As in continue the benefit for the earlier LTCG and the fresh ones for STCG.
Okay.
So that is one thing people should keep in mind for clarity on taxation.
Yeah, it's important because it is applicable only from 1st April. So any fresh investments in debt mutual funds from 1st April will not enjoy indexation. Before that, it's status quo, right? So yes, 2 folios make sense. So this is one clarity that is very important in taxation. But of course, we have a lot more questions on this one.
And in fact, we were talking about how after the debt fund tax changes, that you suggested you could look at multi-asset funds. That would be, one pocket that could perhaps be explored. There's been a lot of interest in hybrid funds also. Suddenly, it seems to have picked up. What do you think about this category, and do you think it's a good option now?
So everything is good. and no issue with hybrid funds. Just to make one point clear, to reiterate, allocation is always relevant. So much to equity in the portfolio, so much to debt, so much to gold or any other asset class like maybe real estate or commodities or anything else in the portfolio. That should be taken care of. So taxation is relevant, but not the criteria for basing your decision. Base a decision on your objectives, on your horizon, on your risk appetite, and according to the allocation to equity, debt, gold, and other asset classes. So hybrid, yes, always good. And there are 6 hybrid fund categories. We have conservative hybrid, we have aggressive hybrid, we have equity savings, we have BAF, and we have multi-asset and arbitrage funds.
So you spoke about BAF, you spoke about arbitrage funds. What about target maturity funds? They are like passive debt mutual funds. And this is a new category as well, which a lot of fund managers are also talking about. What's your take here? How should an investor look at it?
So that's a very good category. It is somewhat new, not very new. It is somewhat new. Yeah. And there are many things going for it. What is it? Firstly, very good portfolio credit quality. Either G-Secs or SDR, as in state government papers, or AAA PSU. So good quality portfolio. High visibility on returns. I mean, nobody can commit, but you get a visibility, an idea how much I will get on the fund. And thirdly, you have so many maturity options, in the sense like 3 years, 5 years, 7 years, 10 years, 14 years, so many maturity options. Or to put it differently, the 2 major risks in debt funds, one is default and one is interest rate risk. Both are taken care of. So as long as you hold on till maturity, you get somewhere around the initial item of the portfolio, that is visibility of returns, and the portfolio credit quality is very good. Which is why gradually TMF is replacing FMPs in the debt mutual fund industry. So 10 years ago, we had more FMPs. Now we have more of TMFs because of this thing, plus liquidity. FMPs, though listed at the exchange, are illiquid. But TMFs, either in the index fund format, you can redeem with the AMC, or in the ETF format, you can sell at the exchange. There is reasonable liquidity. So all these things going for TMF, so it's a very good category.
Yeah, this space has definitely been very popular. One more category I want to ask you about. Just on the last episode, we were discussing the whole arbitrage funds versus liquid funds debate. So you come in on that. What do you think? And do you think that what would you ask someone to consider before they get into liquid funds?
So liquid is for a horizon of 1 week, 2 weeks, 1 month, or thereabouts. Arbitrage, I would say horizon should be ideally 1 year. So 2 things happen there. One is if you are there for 1 year, you go through market cycles. Not the equity market cycles, but the cash future arbitrage cycle, because the spread varies from month to month. Sometimes it is even negative, like it happened in March 2020. So to go through those cycles, ideally 1 year, and you also have LTCG, which is 10% plus surcharge plus sex. Plus, if you have even 6 months, it's kind of okayish. 6 months kind of okayish for arbitrage for horizon, but not like 1 month, because that becomes risky, because the spreads can vary. Plus, there could be margin calls and all those things. So arbitrage is good, but I would say a horizon of, say, 6 months to 1 year is required.
And in 1 month, the expenditure won't be, expenditure would be higher. It won't cost you, it won't be very cost effective also for you if it's just for 1 month. Do you say that? Because what we were told that there's higher penalty also if you just redeem it within 7-8 days.
Talking of exit load?
I'm talking about exit load, yes, of course. So that also comes into consideration when you invest in arbitrage funds.
Yes. That also is there.
Okay. All right.
So basically what I mean to say is liquid is liquid.
Yes.
So minimum 7 days is required as per SEBI regulation, that exit load is there. Arbitrage fund subject to exit load, like 1 month or whatever is the exit load, that you have to take care of. But ideally it should be even longer. Not like just exit load 1 month, so 1 month. No, that's not the way to look at arbitrage funds.
Yeah. Anyway, that is, I wonder if anyone, looking to invest in debt is looking at that shorter category, right? No, but even for a 1 month period, it does seem short. The other space, which I don't know if you remember, so long, right before or right after COVID, we saw this big pickup in balanced advantage fund. It had become everybody's favorite. Everyone immediately moved to that. The flows were going crazy. Why has that come down now? That's one question. And would you advise someone to look at this category right now? Also, you think others perhaps look better within the debt space?
So look at it, definitely yes. That goes without debate. Just to give you a background, what happened earlier was a mis-selling in BAF funds. So some distributors sold BAF funds as 1% dividend per month plus capital appreciation, which is not the way to sell BAF funds. Because see, what is mutual fund? It's a vehicle for long-term wealth creation. It's not post office MIS for giving a dividend so much percentage per month and that kind of thing. So that is, I hope it is over now, that mis-selling is done now. So for whatever the BAF fund is worth, there are so many AMCs with so many strategies. Some say momentum based, some say price to equity, price to book, so many internal funders they have. So as a concept, it is good. You go with the AMC's call. So much is the effective equity exposure. So somebody who is on the borderline, should I invest, not invest in equities? Initially, he or she can take exposure through BAF funds. At least given the current valuation, kind of okayish kind of valuation. So at this point, yes, I would recommend a BAF fund for the borderline investors.
Okay, so we spoke about BAF funds, we spoke about target maturity funds, and you know how there is increasing interest here, but debt mutual funds, still the penetration is not as high, or there is not so much attraction as we see via equity funds. First, do you agree with that? Because that's the general consensus. And second, what would the reason be?
I agree, because if you look at the tradition of our country, people are more used to bank FDs or post office kind of product, or gold, yes. Yeah. So if you distinguish between India and Bharat, Bharat is more into physical, okay, it's changing now, thankfully. But Bharat is more into physical, Zameen, Jaidad, gold, bank, LIC, post office kind of culture. That is thankfully changing, but that is the reason why penetration is low. So as of now, debt mutual funds are gradually gaining ground, but even then, having said that, if you look at liquid funds, it's more corporate than individual. That is still there. Plus, tax thing is gone now.
So yeah,
that used to be one tool for popularizing debt funds. Anyway, can't help it. But yes, hopefully with financial reserve savings, hopefully debt mutual funds will gain more popularity with individual investors over a period of time, even without taxation advantages.
Okay, and we are going to get your help in suggesting some categories as well.
Sure.
So, like we were talking about, there are a lot of new investors, and the number of categories can sometimes be a little confusing, right? In terms of what you should look at, which one is right for you. So I'll give you two instances. One, if someone is looking for a long-term period, say 10 years, they want some debt exposure. And the second, if they're looking for, say, 1 to 3 years. What would you recommend to these kinds of investors?
This is very important. So if it is long, like you said, 10 years, 10, 15, 20 years, you can simply invest in government security funds. Less fancied. Mutual fund industry does not push it. But the point is, there is no default risk. Market volatility will happen. But as long as you have a horizon, 10, 15, 20 years, market risk is taken care of. In the interim, volatility will happen. Don't worry, it is taken care of. And no default risk. For a moderate horizon of, say, 5 or 7 years, there are good funds like corporate bond funds you can invest with a horizon of, or even target maturity funds. You have multiple maturities, like 10, 12, 14 years. You have TMFs at, say, 5, 7 years maturity also. And for a shorter horizon, like, say, 1 year, 2 years, 3 years, there are funds like short duration funds. There are funds like banking PSU funds. There are money market funds. So they are defined. Money market funds, max maturity 1 year in the portfolio. Banking PSU around 3 or 4 years. Short duration, max 3 years in the portfolio. So those funds are there. So you can match your horizon with the maturity of the fund. Like money market up to 1 year, short duration 3 year, banking PSU 3 year kind of, 4 year kind of horizon. So you can match accordingly. And that's the beauty of debt funds.
There is something
in
for
equity,
everyone.
there is no maturity. Whereas in debt, you can ladder. Like 1 week, 1 month, liquid funds. 2 months, 3 months, ultra short-term funds. 1 year, 2 years, 3 years, short duration, banking PSU, very long maturity, government security funds, in between corporate debt funds, target maturity funds, all those funds are there.
Okay, exactly why we got you here, because as I said, the understanding around debt mutual funds is also slightly more on the difficult side, so it's always good to have an expert. And also you were talking about the number of categories for new investors. I was just looking at the data with Bajaj Finserv's AMC getting that approval. We have 44 AMCs. There are 3 more who have gotten approval. Helios, there is Zerodha, there's 1 more, and there are 4 who are pending approval. So maybe by the time we get all these approvals, 50 AMCs with so many schemes. So always best to get an expert advice here, right, in terms of what to do and what not.
So let the industry go. Let more people come in. Let there be more competition. That actually helps in so many ways. What I would suggest is people should actually consult professional advisors, like a doctor, like a lawyer, like a CA. So why avoid financial advisors?
No, that's completely well taken. Just one final question before we wind down on this show.
Sure.
Consider someone who has a moderate risk profile, a low risk profile, and a high risk profile. What is the kind of debt to equity split that you would suggest? I know there's no one size for everyone, but if you just broadly have to say low, medium, and high risk.
So as I said, very ballpark kind of thing. Typically, conservative means 60-70% debt, balance is equity. Moderate maybe 40 or 50% kind of debt, and aggressive maybe 30% debt, 70% equity, very broadly. But not to forget others also. There is gold and there are other asset classes also. Not to forget those.
Oh, yes, of course. And that's again a ballpark figure, as you said, for everyone. Diversification differs in the way their risk profile and the investment amount is as well. Mr. Sen, it was a pleasure to have you with us in the studio and discuss debt mutual funds at such an important day. So thanks a lot for joining in. And with that, we'll take your leave on this edition of Mutual Fund Corner. Do remember to email us your queries and we'll address them with our experts, leaving you with some market opinion from Sanjeev Prasad, the Managing Director and Co-Head at Kotak Institutional Equities. Stay tuned for Closing Bell to take you through the last hour of trade.
Well, I completely avoid that, to be honest with you. There's no way I can forecast the earning numbers of the OMC companies, given the fact that you have just too much volatility in the earning numbers to start with on the refining side. Clearly, the mood of the market is very bullish. As of now, what we are seeing is the market is latching on to any positive news in the short term. So we have seen the market getting very excited by improvement in profitability, but ignoring the weak volume part. Same way the market is very excited on the macro improvement, which is genuine. We have seen a big decline in inflation, interest rates are probably peaked out, current account growth is looking very reasonable. So some grounds for optimism, but at the same time, the market simply does not want to look at any negatives which may play out, which is, maybe a much more muted recovery in consumption demand, which so far has been, pretty weak. And some of the medium-term challenges which come from the disruption side, anyway, that's 4 years down the line, so people don't want to focus it as of now. Clear message from the management has been, in most cases, that the focus has shifted to profitability rather than growth. So if the market, narrative is focused on profitability, the companies are in a position to deliver that. You stop growth for some time, you will become profitable. And to be honest, the company has also been working pretty hard on improving the profitability. So I wouldn't be surprised something like Zomato in maybe 4 to 6 quarter times, start becoming actually profitable on the food delivery side.